Okay, good afternoon, grade 12. I will be continuing the lesson from where we stopped. In our previous lesson, we looked at some basic concepts whereby we spoke about the principles of insurance. We looked at the insurable interest, the utmost good faith. We looked at indemnification. We looked at security and what it means. And we also look at some basic concepts like reinstatement, like excess, like average clause, over insurance, under insurance, and insurable risk, non-insurable risk. And today I will be starting from the calculation of under insurance. For under insurance, remember I said that is when the insured, which is the business or the individual, actually under insure the value of their asset. And in a situation whereby the asset is being damaged or is being stolen, what kind of how does a claim work? What kind of calculation is being used in paying that person out? And we will be looking at under insurance and over insurance. The formula is the same. And when you're talking about under insurance, it occurs when property or assets are not insured for full market value. It is insured for less than the actual value of the property or the asset. So for you to get what the claim is going to be, there is a formula in your booklet. I'm reading from page 74, chapter 13. And the formula will be amount insured divided by the market value multiplied by the damages. And when you look at page 75, there is an example that is being given to us. Paul owns a factory outside Port Elizabeth. The building was damaged by fire. The damage to the building was estimated at 300,000 rand. The factory is insured for 780,000 and the current market value is 1.2 million. So obviously you can see that the business was actually underinsured because the value of the business was 1.2 million, but the business was only insured for 780,000 rand, which means the owner of the business is going to bear some excess in terms of adding up, because the insurance company will not pay you more than what your premium is with them. Remember I said in our previous lesson, you do not make profit with an insurance company. So doing the calculation, the formula will be amount insured divided by the market value times the damages, which is going to be 780,000 divided by 1.2 million times 300,000. So the business, the insurance company, which is the insurer, will only be paying out 195,000 rand. So as time goes on, when we get back to the classroom, we will be doing revisions on all those calculations. Remember, we still need to look into the simple interest, looking into the compound interest, and also we can also look at the claims from an insurance company and how much is going to be a payout. So today I will be concentrating on compulsory and non-compulsory insurance. So when you're talking about compulsory insurance, what is the difference between it to a non-compulsory insurance? So let's take a look. A compulsory insurance means it is required by law, it is legal obligation for it to be taken out, and it is being paid for. And it is regulated by government and does not necessarily require insurance contract or a broker. So when you're talking about a compulsory insurance, it is a must. It has to be carried out. Number two, it is a legislation. It is a law. Number three, it's been legislated by the government. And remember, when we're talking about the government, we refer to them as regulators, which we find in the market environment, and at the same time, we find them in the macro under the legal environment. When government puts rules and regulation in place, we refer to them as what? It is compulsory. So when you're talking about compulsory insurance, those are insurance that have been legislated by the government. It is a must. It has to be carried out. You do not have an option. And at the same time, payment is in the form of a levy, a contribution, paid into a common fund from the benefit, which may be claimed under certain condition. So when you're talking about compulsory insurance, we only have 3 compulsory insurance in South Africa, which is being legislated by the government. You need to follow the procedures. There are rules and regulation in place, and the moment you contravene all those laws, there is going to be a penalty for doing that. So before I go into the types of compulsory insurance, remember I said we have 3 of them. Let me quickly go to non-compulsory insurance. So when you're talking of non-compulsory insurance, it's just the opposite of a compulsory insurance. So non-compulsory insurance means that it is voluntary. The insured has a choice to enter or not into an insurance contract, which means, in other words, is not legal, is not being enforced by the law, is not being enforced by the government. Is just out of your willingness, like, oh, I think I just want to do it. It's just by choice of individuals or a business. The insured will enter a legal insurance contract with the insurer, who may be represented by an insurance broker. A monthly annual payment premiums must be paid in order to enjoy a cover for a nominated risk or an insured event. So we have examples of a non-compulsory insurance. Number 1, we have short-term insurance. We have multi-peril insurance, that is for theft and fire. We have long-term insurance. We have life insurance. We have household insurance, because we have some people, they actually insured everything they have in their house, including the cutlery. Depending on how valuable your assets are, you can decide to insure them. Remember, non-compulsory insurance is by choice. It's how valuable your assets are. It can be your wristwatch, it can be your wedding ring, it can be your car. A car is also an example of a non-compulsory insurance. Not everybody insures their car. It's out of, I just want to insure my car. So let's now take a look into a compulsory insurance. So when you're talking of a compulsory insurance, you'll be talking about the UIF, which I'll be speaking about. You'll be talking about the road accident benefit scheme. The road accident benefit scheme used to be the road accident fund. Now it has been changed. It has been replaced, but at the same time, it's still serving the same purpose. So we have the UIF, we have the road accident benefit scheme, and we also have what we refer to as COIDA. Remember, we did COIDA as part of the macro legislation in term 1. So let's look at UIF as a compulsory insurance. The UIF provides benefit to workers who have been working and becomes, please, I want you to underline that, they actually become unemployed for various reasons. I'm sure you've been watching the news. You've seen retrenchment that is going on in different workplaces. You see people losing their job because of this economic situation, retrenchment going on. People that are unemployed can go to UIF, and that is what the government is saying. You can go to UIF, that is Unemployment Insurance Fund, to actually claim when you don't have a job. And also for more reasons, which I will be talking about. So how does it work? Businesses, and to me, in that second bullet in the booklet, I actually want to put it in brackets. The second bullet, it's actually serving the purpose of how it is being funded. Okay, where do we get it from? How is it being funded? Businesses contribute 1% of basic wages towards UIF, therefore reducing the expense of providing UIF benefit themselves. So every month, the business contributes 1% of the business wage to UIF. And the third bullet says that employees also contribute 1% of your basic wage. That is before you get your salary. 1% has to go out of your salary, goes to UIF to cover you in case you lose your job. In case there are a lot of things you can go to UIF for and claim that anything that keeps you out of job. And which means that when we're looking at how it is being funded, we can see 1% actually comes from your employer every month, and 1% also comes from you every month, which means 2% goes to UIF every month on your behalf. So the employee and the employer do contribute towards UIF, and which serves a purpose in form of a benefit to the business when you don't have a job, when you are being retrenched, the business don't have to pay you. You can go to UIF to claim your UIF from them. So it is a compulsory deduction. It's actually being taken out from your salary by your HR before you earn your salary every month. Businesses are compelled. I actually want you to underline that. When you're talking about compelling, it is forceful, it is legal, it is compulsory, it is legislated. It is being backed by the law to register every employees with the fund and to pay contributions to the fund. So which means that you have 2% goes to UIF every month. 1% of my salary goes to UIF every month before I earn my salary, and my workplace also take 1% from the wages, and they have to pay to UIF. And yeah, I will be speaking about that more. I think there's more about UIF later on. And number 2, we have RAPS, which is the Road Accident Benefit Scheme. It insures every road users. When you're talking about every road users against the negligence of other road users, every road users, anybody that works on the road, is being covered under the Road Accident Fund. Covered in what sense? If you have been injured, you've been knocked down, you've been run into by the negligence of other road users. But remember that UIF is very, very tricky. You need to be careful when you're using the road. You need to do it in a very appropriate way. I always give the instance to my learners every time that if you are supposed to use a pedestrian, please make sure you use a pedestrian crossing. That is what we refer to as the zebra crossing. If you do not comply with all those rules as a road user, you might not be compensated by the Road Accident Benefit Scheme. And at the same time, the Road Accident Benefit Scheme provides compulsory cover for all road users in South Africa, which include South African businesses. And where is that fund? Where does it come from? On page 79, on the third point, I actually want to put it in brackets. I'm putting mine now. How it is being funded. Where does the government get the money from to pay out people that have been knocked down on the road or due to negligence of someone else? So it is being funded by levy on the sale of petrol, of diesel. Everybody that buys petrol in South Africa contributes towards the Road Accident Benefit Scheme. I could remember, I stand to be corrected. I actually want you to look into that. It used to be 46 cents on every 1 liter goes to the Road Accident Benefit Scheme. Every 1 liter you buy. So which means if we're buying a petrol for maybe like, I'm not so sure, it keeps on fluctuating, maybe 11.60 rand. Obviously, that is per liter. So 46 cents from that goes to the Road Accident Benefit Scheme, or the Road Accident Fund. So which means every day there is a lump sum that goes into the Road Accident Fund. So let's take, for example, if I accidentally knock someone down or someone just run into me, I don't need to compensate that person from my pocket. That person can actually go to the Road Accident Fund, and they can be compensated because I buy petrol, and every time I buy petrol, I buy diesel, I buy fuel, it actually 46 cents goes to the government in terms of the levy. And the next of kin of workers or the breadwinner who are injured, killed in the road accident may claim directly from the road accident benefit scheme. So in a situation whereby the accident actually leads to death, it means the dependent of that person can also claim from the road accident benefit scheme. And also injured parties and negligent drivers are both covered by the scheme, and RABS enables road accident victims speedy access to medical care as delays due to the investigation into accident has been minimized. Okay, before it has to be a long process, I've shared this. My learners do share things like this with me, like means I've got a grandma or my grandpa was knocked down by a reckless driver and he hasn't been paid yet after 7 years, because proper investigation has to be done, and at the same time, before you can be paid out, there is going to be a kind of an investigation where how it happens. Doctors needs to do findings, and at the same time you have to be treated in a government hospital. You cannot be treated in a private hospital. If you are being treated in a private hospital, the government will only pay private hospital what public hospital is going to charge. So it used to be a long process, but now we can see that the medical care that used to be very delayed is actually getting improved. So that is that on the road accident benefit scheme. And the third compulsory insurance that we have in South Africa, I don't need to really go into that, but for the benefit of those people that have forgotten, it's the Compensation for Occupational Injuries and Disease Act, and that is what we refer to as COIDA, and it compensates employees for injuries and diseases that happen at work or during the course of work, inside the business or outside the business, but you actually carrying out the workplace job. The contribution payable is reviewed every new year according to the risk associated with that type of work. So when you're talking about how COIDA is being funded, it's only the employer, please put it in brackets somewhere in your notebook. It's only the employer that actually contributes towards COIDA in the workplace. It compensates employees for injuries and diseases incurred at work. But remember, I laid emphasis on that it doesn't cover employees' foolishness. So the only time you can be compensated is when you comply with the workplace safety guards, with safety rules. You're supposed to wear your boots, you're supposed to wear your gloves, you're supposed to wear your mask, you're supposed to wear your helmet. And even after following all those precautions and something still happens to you in the workplace, that is when you get to be compensated. But in a situation whereby you do not follow rules and regulations put down in the workplace in terms of the safety precautions on how to operate a machine, you will not be compensated. And remember, when you're talking of COIDA, it can be a disease, it can be an injury, and an injury can be a temporary one, it can be a permanent injury, and it can actually lead to death. So in a situation whereby you do not comply with the workplace rules and regulation, after investigation has been done and they could actually see that it was due to your own foolishness, then you would not be compensated. Then you run at a loss because of your foolishness. Compensation is determined by the degree of disablement. Can you see? So, which means if you have a broken arm and someone has maybe lost his memory because he fell down from a tower, now you can't get paid the same amount of money. So it depends on the degree, the severity, like how impactful is that disablement to you. And in the event of death of an employee as a result of work-related accident, diseases, his or her dependent will receive financial support. I said it to my learner, you work for the company, you are a delivery guy, you're supposed to deliver to a guy, to a shop, or to supply goods to a shop in and let's take for example in Philippines or in Langa, but you had an accident in Kailicha because you wanted to go and say hello to your girlfriend, you would not be compensated, because you are not within, how can I say it, you are not complying with workplace rules and regulation, and you're actually doing your own things. Employees do not, I actually want you to underline that fact. Employees do not contribute towards that fund. It's only the employer that contributes. Employees receive medical assistance provided there is no other party or medical fund involved. In the event of death of an employee as a result of a work-related accident or a disease. When you're talking about work-related accident can be broken arms, you fell from the tower, you fell from the building, you were stalking, you were shelving, and you fell. Okay, fine, those are accidents. When you're talking of diseases, let's take for example, we have people working in the mine. People working in the mine, sometimes they actually contract a lot of diseases, like sometimes they have how can I say, sometimes they can have poor eyesight, sometimes they have been exposed to dangerous emissions, let me use that word. You can contact diseases, and in that kind of a situation you will be compensated. That is if you follow the workplace procedures that are being put in place. And yeah, those are the three compulsory insurance we have in South Africa. We have the UIF that is being funded by both the employee and the employer. 1% goes to UIF, so that when you out of job, you can claim it. We have the road accident fund, or we can actually call it the road accident basic scheme. It's also being funded by every users, that is everyone that drives, that buy petrol, that buy diesel, that buy fuel in South Africa, and certain percentage, I was saying it should be 46 cents per liter if it hasn't changed. If it has changed, we will look into that, then I will actually make a correction while I'm answering any of your question. And lastly, we have the COIDA, which is not new to you. Those are the three compulsory insurance we have in South Africa. So let me just quickly look into, I'm trying to look at my time, and yeah, let me just take a break, and I will continue in my next video.